everyone. Welcome again. This is Robert Schein, Managing Director and Partner at Blanke Schein Wealth Management. Thank you for joining us for our market insights and observations. Today is Tuesday, May 23rd of 2023, and we got three topics we're paying attention to, and you should be too. Thanks for watching. So three topics today are the debt ceiling negotiations. It's a on-again, off-again theatrics, which has pretty dangerous implications if something doesn't get done. And we'll talk more about that in a minute. Recession Watch. Where are we in this overhanging recession, which potentially is upon us in the back half of 2023? And then also looking at history, we got an interesting chart to discuss about what is the first 100 trading days of the market tell us about how the rest of the year plays out. And we'll take a look at that. But let's go down to my scribble on the board. Earlier today I was doing some research, and let's just take us back to history right now. Part of the sort of bipartisan disagreement right now is basically on spending. And whether you're on one side or the other side or in the middle of the aisle, ultimately a bipartisan agreement has to take place for a deal to get done. That's ultimately how negotiations work. So there has to be a give and a get. One of the key topics here and key sort of sticking points is one side wants to continue spending while the other side wants to reduce spending and sort of say, hey guys, if we look at the last 5 years, we've done an awful lot of spending, ultimately adding to our U.S. national debt. Let's take a pause. Let's sort of agree to disagree to cut down some of the excess spending and then really look at where we can agree on and what we need to on a prioritization scale, not only just for the debt ceiling debate, but on the budget debate moving forward. And going back to 2017, every economist, everybody out there in Washington basically was pointing to, especially on the Democrat side, that the Trump tax cuts would reduce the overall tax revenue for the government. And they basically said by all analysis that when you cut taxes, you're going to get less in the kitty for revenue. Well, let's look at that for the sort of tax collections. Back then, it was $3.3 trillion. So U.S. tax receipts were over $3.3 trillion in what they brought in, and then they passed the Tax Reduction Act. And fast forward today, we're at $4.8 trillion of tax receipts. So how does that math work? How can you cut spending, or excuse me, how do you cut ultimately give tax cuts out there and ultimately still have the revenue grow for the Treasury? And it's really simple. If you grow the economy, the amount of dollars and the velocity in the U.S. economy, let's say we grow the GDP, let's say we give the money back to small business owners, they go out and reinvest. It's not like you're not reinvesting, and that additional revenue or growth in the GDP adds to the top line, sort of the growth of the U.S. economy. That top line growth of the U.S. economy is by nature going to receive more taxes. And that's ultimately what we see here. Now, if you look at the national debt 5 years ago, again, just looking at pure math, we're at $20 trillion. Obviously, we had COVID and a lot of emergency measures between now and then and stimulus. Well, that's ballooned to $32 trillion and counting, and now our cost of service debt is gone way up because interest rates in the Federal Reserve has raised the Fed funds rate to over 5%, 10 times in the last, 10 times about a year and a half. And that's a 40% increase in the national debt. So they're not off base when they say, guys, let's take a time out. Let's agree to disagree on some things, but let's see if we can curb the spending. And that actually happened back in 2011. For every $2 trillion of what they had to raise the debt ceiling, they were able to compromise and bring up $2 trillion of basically cuts of spending in the future. And ultimately it was a dollar for dollar, and that's how they agreed to disagree, but they passed something, and that was at the 11th hour, and it was a really stressful time for the markets. Well, let's look at what the government is doing right now. The government spending is at $6.4 trillion. The annual revenue, or what they bring in tax receipts, is $4.8 trillion. So that's a deficit here of $1.6 trillion, and that's just going to be added to the national debt. So something has to happen at some point in time, and adults have to reappear in the room potentially and really take an honest look at maybe where they could potentially freeze or even reduce spending, because that's not sustainable. The more the national debt goes up, the more the cost of everything goes up. And if we're in inflationary pressures right now, and we believe, and if you and I believe the kitchen table sort of inflationary pressures are there, you wait and see. If this national debt continues to spiral upwards, everything's going to become extremely more expensive. We're going to have our dollar be devalued, and we're going to have a pretty serious situation. So how we stay out of this is ultimately you want to own real assets when we're in a time of inflation, and that's what we're doing at Blanke Schein Wealth Management for our clients, so that it can grow ahead of the pace and stay the pace of inflation over time. But consensus is growing that ultimately we're going to see a recession ultimately later on this year. And if we look back at what all of what I love about this chart real quick is this is the consensus, meaning all of the forecasters on Wall Street. Okay, if we look at the forecasters on Wall Street, all the gurus, all the economists, and look at all these sort of plot lines, and what each one is a revision. Each color is a revision every month over month over month of what the anticipated start date of what our GDP looks like. Remember, if the GDP declines by 2 consecutive quarters, so the economy contracts, and ultimately contracts consistently for 2 or 3 quarters, then you have a technical recession, and that's where the U.S. economy is just slowing down. Well, this is going back to September, October, November of 2022, December of 2022, and every forecaster had it here, and they're pushing it back. This is what makes it comical, is that this is the timeline, and now we're basically close to middle of 2023 right now, and we're still pushing back the forecast, at least the consensus, the experts. And we do believe we will see maybe the back half of this year a slowing decline of the GDP. But ultimately, here's what's funny is that they see it bouncing right back. So it's a slow to shallow recession. But it's taking time, but consensus is ultimately not there. Now, what are we looking at versus reading what the analysts are saying here at Blanke Schein Wealth Management is really the spreads, the treasury spreads and the high yield market. And ultimately, high yield is the pressure that's built in, and it's the junk of the corporate lending market, if you will. So high yield is the most economically sensitive. It's the highest yielding, highest priced fixed income out there. Therefore, it's high for a reason. If you ask me, several people, as I say, hey, Rob, what do you do, in terms of like really sniffing out, a sort of quality versus non-quality. Well, if something's yielding something like 9-10%, if it's high, we ask why. Well, it's a higher risk. We don't allocate to high yield. There could be some a little bit into client portfolios. There's always a time and place. But right now, we're in the treasury side of the yield curve for fixed income. It's the higher stack of quality, less sensitive to sort of an economic recession, if you will. And we're also shorter in duration. But we do pay attention to the Barclays High Yield Index relative to treasury spreads. And ultimately, we see this blow out back in 2008, going back in 2001, and then obviously going through COVID. Now, right now, we're still in sort of a nothing's pricing in a recession if we look to that high yield to treasury spread right now. If this starts to spike up, that will then be a pretty good indication that the recession will be imminent. But ultimately, the high yield market to the treasury market is the one we pay attention to. Is another head scratcher, because if you go to all the economists at the very beginning of the year, every single one of them was sort of on the camp of not only we're in a recession, but we could see a negative trading market, at least for the first 6 months, at least. That's why there's a lot of cash on the sidelines. So when you see rallies continue, you see rallies persist even higher, because there's money on the sidelines, especially money managers, if you will, or institutional and definitely retail clients, and they're playing catch up. So they're pushing the markets, or it's the FOMO, fear of missing out. Well, let's go back to, this is by Bloomberg earlier today. What is the first 100 days, and if they're strong, according to the S&P 500, how does that bold out, or what really plays out in history? And ultimately, the strong first 100 days on the index almost would lead to a significant upside for the rest of the year, historically speaking, as our guide. If 2023 is on track to follow that analog, anything for a greater the first 100 days, if it's greater than more than 8% during that period, the average annual return for the benchmarks, going back to 1950 on the S&P 500, are positive on every single one of them. And the S&P right now is above the 9% or above the 8% at 9.2%. So this is going all the years. That's basically just showing if the year starts off strong by way of the first 100 trading days, what is the year-end performance? And just a quick glance, again, we'd love for history to repeat itself in this particular case, but it also shows that we don't know how it will end, but the average rate of return, if we look at all of those years going back to 1950, is 25% annual rate of return on the S&P 500. That's this one right here. And there's some key notes right there. 1987 is on this. I don't think anybody would have guessed. The first 100 trading days of 1987 was up 19%. Obviously, October of 1987, we had a good 30 to 40% decline in the S&P 500. The market ended up higher that year. That is just incredible to see something like that. And these gray bars here, here, and here are all recession. So you could still have, again, we started the conversation with recession. We also started the conversation with what does the market tell us? We're looking at the high yield market to treasuries. They're still in line and intact right now. But we also say, hey, listen, historically speaking, if you have a good start to the year, we've seen, historically speaking, a good finish to the year. But there's a lot of, again, we have to get through the next week and a half of the debt ceiling, and who knows what the market and the geopolitical sort of headlines have for us moving forward. But we're basically staying balanced, defensive, and diversified here for our clients at Blanke, Schein Wealth Management. So that's our update for today. I hope you enjoyed it. And thanks for watching. We'll see you again next time. Again, like, subscribe, and share it to friends and family. If there's somebody you'd like on this, please let us know, and we're happy to add them and have them add them and join them to the group that gets our updates. Take care. Have a great day.